Image_style, Pixar_3D, image_style_reason. Pixar 3D renders abstract policy mechanics as warm, emotionally grounded visuals that make invisible insurance clauses feel tangible and human. Most people who have long-term disability insurance have never actually read the document that comes with it. They enrolled during open enrollment, checked the box, saw a payroll deduction, and moved on. And that felt responsible. That felt like the right thing to do. But inside that document, the one sitting in a benefits portal most people haven't opened in years, there is a single sentence that determines almost everything about whether a claim ever pays out. Not a paragraph, not a section, one sentence. And most policyholders have no idea it exists. This video is about that sentence, what it says, why it matters, and how to find out which version of it is sitting in your own policy right now. We are not going to cover every clause in a disability policy today. We are going to focus on the one mechanism that has the largest single impact on real-world claim outcomes, and walk through it clearly enough that you can actually evaluate your own situation tonight. Let's start with what disability insurance is supposed to do. The basic idea is straightforward. If you become sick or injured and cannot work, disability insurance replaces a portion of your income, typically somewhere between 50 and 65%, for a defined period of time. That income bridge is supposed to protect your household from a financial collapse that health insurance alone cannot prevent. Health insurance covers your medical bills. It does not replace your paycheck. So if you are the primary earner in your household, or even a significant contributor, and you lose the ability to work for 6 months, a year, or longer, disability insurance is supposed to be the thing that holds everything together. That is the promise. But whether the promise actually delivers depends almost entirely on how your policy defines the word disabled. This is where most people stop reading. The word disabled sounds self-explanatory. If you cannot work, you are disabled. Simple. Except that is not how insurance policies define it. Every long-term disability policy contains a specific legal definition of disability, and that definition sets the bar you have to clear before any benefit is paid. There are two primary definitions used in the U.S. market, and they are not equal. The first is called own occupation. Under an own occupation definition, you are considered disabled if you cannot perform the material duties of your specific occupation, the job you were actually doing when you became sick or injured. A surgeon who develops essential tremor and can no longer safely operate is considered disabled under own occupation, even if that surgeon could theoretically answer phones or teach a class. The second definition is called any occupation. Under any occupation, you are considered disabled only if you cannot perform the duties of any occupation for which you are reasonably suited by education, training, or experience. That same surgeon, under any occupation, might be denied because a claims review could determine they are capable of working in some other capacity, even a far lower paying one. Same diagnosis, same career impact, completely different outcome depending on which definition your policy uses. This is not a theoretical edge case. This is a real distinction that affects real claims every year across the country. And here is where it gets more complicated for most people. The majority of group long-term disability plans offered through employers do not lock in one definition for the entire benefit period. They use own occupation for the first 24 months of a claim, and then automatically switch to the any occupation standard after that. That shift happens quietly. There is no letter. There is no warning phone call at month 23. The policy just changes the rules you are being evaluated under, and if you no longer meet the new and stricter standard, your benefit stops. This is not a billing error. It is not a mistake. It is how the policy was written from the beginning. It was in the document. Most people just never read that far. Image_style, Pixar_3D, image_style_reason, maintaining the established Pixar 3D visual language for warm, legible rendering of abstract policy mechanics across all scenes. So let's talk about what that shift actually looks like in practice, because the numbers matter here. Say you file a claim at month 1. You cannot perform your job as a physical therapist because of a back injury. Under the own occupation standard, your claim is approved. Benefits start flowing. Month 12. Same injury. Still can't do your job. Still approved. Month 24 arrives. The policy quietly switches to the any occupation standard. Now the question is no longer whether you can work as a physical therapist. The question is whether you can work at all, in any capacity that your education or training would support. If a claims reviewer determines that you could work as a medical billing coordinator, or a health education consultant, or a customer service representative for a healthcare company, the benefit can stop. You have not recovered. Your income has not recovered. But under the new definition, you no longer qualify. That is the cliff. And most people do not know it is there until they are standing at the edge of it. Now, it is important to understand that this shift is not always the outcome. Some people do successfully continue benefits past the 24-month mark under any occupation review. The conditions that usually support continued benefits include a condition that genuinely prevents sedentary work, documented cognitive or neurological impairment, and the absence of any realistic alternative occupation given the claimant's specific background. But the burden of proof shifts significantly at that transition point, and many claimants are not prepared for it. The people most exposed to this gap tend to share a few characteristics. They hold specialized, high-skill jobs where the income gap between their profession and any alternative occupation is enormous. A dentist who can no longer practice due to hand tremors could theoretically teach, consult, or work in dental sales. But the income difference between practicing dentistry and those alternatives can be measured in hundreds of thousands of dollars per year. The policy, under any occupation language, may stop paying, even when the financial damage to that household is real and severe. A software engineer who develops a chronic condition affecting concentration and fine motor control faces a similar gap. Plenty of lower-intensity jobs might technically be available, but technically available is not the same as financially equivalent, and it is not the same as personally sustainable for someone managing a serious medical condition. This is why the definition language is so consequential. It is not abstract legal language. It is the exact standard that a real claims examiner will apply to a real person's real life during the worst stretch that person has probably ever experienced. There is another layer to this worth understanding, and it involves the difference between short-term and long-term disability. Most employer benefit packages include both. Short-term disability typically covers the first 3 to 6 months of a disabling condition. Long-term disability picks up after that, once the elimination period has been satisfied. The elimination period is the waiting window between when your disability begins and when your long-term benefits actually start paying. Most employer-sponsored policies have a 90-day or 180-day elimination period. During that window, you are relying on short-term disability, sick leave, or personal savings. If those run dry before long-term kicks in, the gap becomes a crisis before the main coverage even activates. And here is something that catches people off guard about the elimination period. It does not automatically mean 90 days from the first day you call in sick. Your condition typically has to be continuously disabling throughout that entire window, and documented throughout as well. A gap in treatment, a return-to-work attempt that fails, or incomplete medical records can reset or complicate the clock. This is not designed to trap people, but it does mean that how you manage the early weeks of a disability claim has real consequences for when benefits begin. The lesson here is that disability insurance is not a passive backstop. It is a system with specific rules, specific timelines, and specific definitions, and knowing those rules before you need them is the entire point. Most people learn this too late. Image_style, Pixar_3D, image_style_reason, maintaining the established Pixar 3D visual language for warm, legible rendering of abstract policy mechanics across all scenes. So where does that leave you right now, and what can you actually do about it? The first step is simply locating your policy document, not the enrollment summary, not the benefits overview your HR department handed you on a one-page flyer. The actual plan document, sometimes called the summary plan description or the certificate of coverage. These documents are typically available through your employer's benefits portal, or you can request a copy directly from your HR department or your plan administrator. If you have been with the same employer for several years, your benefits may have changed at renewal without a clear notification. The document you need is the current one, the version in effect right now. Once you have it, you are looking for one specific section. It is usually labeled something like Definition of Disability or Disability Definitions. It may be a short paragraph. It may have subsections, but it will be there. Read it carefully. Does it say you must be unable to perform the duties of your own occupation? Or does it say you must be unable to perform any occupation? And if it says own occupation, note whether that language holds for the entire benefit period or only for the first 24 months. That transition language is sometimes easy to miss because it appears as a continuation clause rather than a headline change. Look for phrases like after the initial benefit period or following the own occupation period or thereafter. You will be considered disabled if. Those phrases are where the definition shifts. That is the sentence this entire video has been building toward. Now let's talk about the benefit period itself, because this is the second major variable that shapes what your policy actually delivers. The benefit period is how long your policy will pay benefits, assuming you remain disabled under the applicable definition throughout. Common benefit periods in employer-sponsored group plans are 2 years, 5 years, or benefits payable to age 65. A 2-year benefit period sounds reasonable until you realize that the average long-term disability claim in the United States lasts significantly longer than 2 years for serious conditions. Chronic illnesses, degenerative conditions, and mental health disabilities, which now represent a substantial portion of long-term disability claims, often extend well beyond that window. If your benefit period ends while your condition continues, your income protection simply stops. There is no automatic extension. There is no grace period. The policy has paid what it promised to pay, and that chapter closes. This is why understanding your benefit period matters as much as understanding your definition of disability. Both variables together determine the real shape of your coverage. There is also a cap worth knowing about: the monthly benefit maximum. Most group disability policies cap the monthly benefit at a flat dollar amount, regardless of your actual income. Common caps range from $5,000 to $10,000 per month, though some higher-income employer plans push that ceiling further. If your income is significantly above the cap threshold, the percentage replacement figure you were shown at enrollment, the 60% your company highlighted, may not actually apply to your full salary. A professional earning $15,000 a month with a $10,000 monthly cap is not receiving 60% income replacement. The math produces something closer to 67% on paper, but the effective replacement rate relative to their full income is only about 47%. That gap is real, and it compounds quickly during a long-term claim. It is also worth noting that benefit amounts from employer-sponsored plans are often taxable if the employer paid the premiums, which most do. So the net check you receive after taxes is lower still than the monthly maximum the policy advertises. This is not a loophole or a trick. It is simply how the tax treatment of employer-paid disability benefits works under current IRS rules. But it is something many policyholders discover for the first time when they file a claim, not during enrollment. Knowing this ahead of time means you can factor it into your household financial planning now, rather than recalibrating in the middle of a crisis. Image_style, Pixar_3D, image_style_reason, maintaining the established Pixar 3D visual language for warm, legible rendering of abstract policy mechanics across all scenes. Let's bring this into a practical framework, because understanding policy mechanics only matters if you can actually apply it to your own situation. Think of your current disability coverage as having 4 dimensions: the definition of disability, the elimination period, the benefit period, and the monthly benefit cap. Each one is a variable, and when any one of them is weaker than you realized, the whole structure delivers less than you expected. Start with the definition. You now know what to look for. Own occupation for the full benefit period is the stronger version. Any occupation from the start, or after 24 months, is the version that narrows your protection precisely when a long-term claim becomes most costly. Now look at your elimination period. 90 days is common. 180 days is also frequent in employer plans. Ask yourself honestly, if your income stopped today, how long could your household sustain itself before serious financial damage sets in? If the answer is less than your elimination period, that is a gap worth noting. Not a reason to panic, but a real number to factor into your household emergency fund calculation. Next, check your benefit period. If it caps at 2 years or 5 years, think through the conditions that are most statistically likely to affect someone in your age group, your occupation, and your health history. Back injuries, cardiovascular conditions, cancer, and mental health disorders are among the most common drivers of long-term disability claims in the United States. Many of those conditions extend well beyond a 5-year horizon. A 2-year benefit period covers a broken leg or a surgery recovery. It does not cover a chronic autoimmune condition or a degenerative neurological diagnosis. Then run the monthly benefit math honestly. Take your monthly gross income, find your policy's stated replacement percentage, apply it, then check whether a monthly maximum cap cuts that number down. Then subtract estimated taxes if your employer paid your premiums. What remains is your actual expected net benefit. For many people, that number is meaningfully lower than what they pictured at enrollment. None of this is meant to alarm you. Knowing the real number is the starting point for deciding whether it is enough and what, if anything, you want to do about it. One option that some people in high-income or specialized professions explore is supplemental individual disability insurance. Unlike group plans, individual policies can offer true own occupation coverage for the full benefit period with no 24-month cliff. They are underwritten individually, which means your health history matters. They are generally more expensive per dollar of coverage than group plans, but they fill a specific gap, the gap between what your group plan promises and what your household actually needs. Whether that option makes sense for your situation depends on your income level, your occupation, your existing coverage, and your household financial reserves. It is a question worth asking a licensed insurance professional who works with disability products specifically. Not every agent has deep familiarity with this category. There is also a softer version of preparation that does not involve buying anything. Simply documenting your occupation clearly, its material duties, the physical and cognitive demands, the income level, creates a clearer record that can support a claim if you ever need to file one. People whose job duties are vague in their own policy file are harder to evaluate under an own occupation standard, and that ambiguity does not always resolve in the claimant's favor. The cleaner the record of what your work actually requires, the more useful that documentation becomes if the definition of disability ever has to be applied to your specific situation. This video covered a lot of ground, but it all comes back to that one sentence. The definition of disability inside your policy is not bureaucratic fine print. It is the rule that determines whether the coverage you have been paying for will actually function when you need it most. You enrolled in this coverage because you understood that losing your income would be serious. That instinct was right. What changes today is that you now know which clause decides everything, and you know exactly where to look for it. Pull up that document, find that sentence, and read it the way someone who has seen how this plays out in real life would read it. That is the version of informed you want to be before you ever have to use this.